Good life insurance is a wonderful thing to own. It can provide a death benefit that will financially support your family when you die, but it also provides living benefits that can help you grow your wealth while you're still alive. Good life insurance can help you keep more of the money that you make, grow your wealth, and provide the financial peace of mind that you're looking for.
We talk a lot about the benefits of good life insurance, especially the life benefits of good life insurance. People who are familiar with Bank on Yourself, the infinite banking concept, becoming your own banker, and other similar concepts know how helpful benefits of life insurance can be. But today we have sad news. We had somebody write in. When we bought our IUL policies, I did not understand that they were not permanent insurance, nor did I understand the large fees involved. So I'm frustrated and leery of decisions since it appears that it went poorly in the past and was a very large commitment for us for our future to purchase those policies. We thought we were buying permanent insurance with some protections for long term care or disability care, as well as a type of pension in the future if needed. It was retirement planning, and we are getting closer to retirement, and I'm not sure it's going to work out. I'm concerned that we do not have enough time to bridge the gap with the loss of the 4 years we've had the policies.
That's gut wrenching. What a disappointment.
Technically, an IUL policy, though, is permanent insurance, even though it's not.
So it's classified as permanent insurance, whether the benefits are guaranteed to be permanent or not.
If that was the only story we've ever had about someone getting bad life insurance, it'd be one thing. But we are inundated with bad stories and experiences that people have bought the wrong type of life insurance for what their needs are.
Mhm.
And it's really disappointing to have to work with these people that are either oversold or misinformed or actually falsely informed about what a policy can and can't do.
Well, one of the things that makes IUL bad life insurance is all the fees that are associated with it. You have fixed fees, you have fees that are percentage based that take away from the potential growth, participation rates, a lot of different things that come together and end up costing you money.
And the Center for Economic Justice has challenged the insurance companies to write an IUL contract that life insurance agents can understand, let alone the public. And they've not changed their contracts because it's a very productive part of the insurance industry. And the reason is because you can lose 100% of everything you've put in an IUL policy.
With all policies, whether it's term, whole life, IUL, UL, VUL, there is a policy fee, like a flat fee that goes with the policy. It's built into the policy. But then when we talk about these IUL policies or UL policies, they have all kinds of other fees, premium fees.
And that's a
Uh,
percentage fee. So if you pay $100 and the fee is 6%, well, you can figure out pretty easy you're going to pay $6
on just that
on
fee.
just that $100. But if you're paying $10,000, now you're paying a huge
Paying
portion,
6% of that.
6% of that, or
Okay.
A huge
100,000.
amount.
Yes,
Yeah.
and those fees last for about 15 years on the front part of the policy. So it, like you said, it robs what you could be putting into the cash values of a life insurance policy.
So fees are one thing that was definitely a pain point that she mentioned. Trust issues. She also has trust issues now because um, obviously she was thinking she was getting one thing and it turns out to be something else. So
Those trust issues can be debilitating if you let them be. But you think about it, we're in a war between good and evil all the time. It's going on all around us. And so we can't get stuck in that thinking. We can maybe we're stuck there because of fear. Maybe we're stuck there because of anger at what happened. Maybe we're stuck there because of shame that I fell for this. I didn't do my own due diligence or thoughts that may have been the case. So how do we get beyond that? It's important to be able to do. And one way I remember Nelson Nash addressing this is when people were concerned about things that they had done in the past financially that were going to limit them or set them back. He would say, draw a line in the sand. Now, go ahead and get over it. And that sounds a little bit harsh, but at some point, there does have to come that dividing line where we make a decision and move on. We have to move past that. And sometimes that could be difficult to do because we want to feel that we had made the best decision, feel a little bit sorry for ourselves sometimes. Or sometimes we just want to recognize that we did the, we want to try to justify that we did the best with what we had. And so we got to stay there for a little while. But we do eventually have to move on. As Christians, we have the grace from God to be able to move past some of those things. But not all Christians seem to take that grace. They get stuck down in the pit and they're limited to what they can do financially and otherwise moving forward. So one of the keys to be able to move forward is to be able to express gratitude.
I think Jesus addressed this when he told us to be wise as serpents and innocent as doves. We need to get the education that we need so that we're not being taken advantage of, because it's not our money that we're putting into these life insurance policies. It's God's money. And so we need to be very, very careful about knowing that we're making the right decisions. And if we've made bad decisions, say, I'm sorry, and get over it, like Nelson said.
Well, one of the problems, she's already mentioned this concern that 4 years have gone by. So to be able to recognize, oh, okay, here's where the problem is. I'm going to cut my losses. I'm going to get over this. Otherwise, how many more years is it going to rob of her being able to get started on the right path?
Yeah, and it's important not to respond to a situation like that with fear or greed, trying to get out of it either, because then you just dig the hole deeper.
Mm-hmm. So our encouragement to this person and to anybody in this kind of situation would be to draw a line in the sand and take those steps you need to get over it and get on the right path.
Time is a big thing, and people think they've got a certain amount of time before they retire or a certain amount of time after they retire to live. And that's one thing that none of us know, how much time we have left. And so to say, oh, I'm going to do such and such in a certain amount of time, Jesus's brother James said, no, if the Lord wills, we will do this or that.
Yes.
So we need to be very careful in making sure that we are wise and redeem the time, like Paul said to the Ephesians, because the days are evil. Everything around us is based on something that is not always what it appears to be.
Mm-hmm. A few things that they mentioned in this write-in to us that would be good to address: long-term care. They thought they were getting something with long-term care attached. Maybe we can address that. They thought that it was something that could contribute to retirement strategy and maybe provide pension-type benefits. Maybe we can address those things. Long-term care insurance is a separate type of policy that covers if you had to go into long-term care. There are some riders that go on life insurance policies like IUL or like whole life insurance. There are riders that go on these policies that do have what's called living benefits. So if you meet certain qualifications, then you can access some of the death benefit early. That is substantially different than an actual long-term care policy. So it's a rider that can give you a little bit of a cushion, but it is important to differentiate that life insurance is not long-term care insurance.
And those riders are usually a complementary addition to a policy. You're not having to pay for those because they're just an early access to your death benefit.
So you don't pay to have that rider on your policy, but once you access that benefit, there is usually a nominal charge, just kind of like for the administration of that. I'm not sure what it would be on IUL policies, but I know on whole life, it's like a flat 200 something for that administration to begin
if you need
that
the rider.
benefit. Yeah,
Okay.
if you need to access the benefit of that rider.
Another living benefits rider that is charged for is a waiver for disability. So a lot of people think, well, I've got a disability policy because I have this whole life insurance or this IUL policy that has a waiver of premium on it. That's not a disability policy that's going to pay you an income. It's a disability policy that's going to cover your premium or a certain part of your premium under very specific disability definitions.
Can be a
Yeah.
great rider. We
Yeah.
put it on policies all of the time, and yet you want to understand the limitations of that.
You say all the time, meaning frequently, but not always. Not
Correct.
always does someone need that rider, but if they do want it, it can be a good rider for their policy.
A lot of this comes down just to trust issues too. Do you trust the person that is selling you the policy? A lot of times people will just buy from a friend or a family member because they feel sorry for the person and they're just getting into the business and they want to support them. And then later they find out this probably wasn't the best policy that I needed because they're going to someone that maybe doesn't have the experience, and not to knock inexperience because we all were there at one time. But are you trusting in someone's friendship or blood relation instead of knowledge? And that's very important.
Something else that happens too is I think sometimes people want to put their trust in someone who is telling them all the things they want to hear rather than listening to the things they hear and see, does this make sense? Are they explaining it in a way that I can grasp and say, I see the truth in that? Sometimes they just want to believe what they're hearing, what they really want to hear. Oh, yeah, you put this money in, you're going to have a fabulous retirement.
Yeah, exactly.
We see that all the time too. So,
And that sounds wonderful, but that appeals to the greed aspect.
mhm.
And we want to have things figured out. So and kind of to the fear as well, because people don't want to feel fear and they want to see a big retirement promise out there. So when it comes to retirement strategy, having guaranteed values is always a great thing. Life insurance can be a great financial tool for that. But the problem in IUL insurance is those guaranteed values go away over time. You can't rely on those. So IUL is definitely not the vehicle you want to use if you want a retirement strategy out of it. Same thing when it comes to the pension aspect. You want pensions provide a guaranteed income for life, or they're supposed to. Some pensions have been underfunded. That's a whole nother issue. But pensions, life insurance is not a pension, but you could take the value in life insurance and say transfer it to an annuity if you wanted to create a guaranteed income out of that. So again, it can be used as a tool. IUL is not the tool to do it because the guaranteed values erode over time.
And there are pension funds that the federal government approves of, but they only allow it to be funded with guaranteed annuities and guaranteed whole life insurance.
Isn't that amazing?
They
Why?
Because they know that IUL will not provide the guarantee in those funds when the time comes that you need to draw them.
And something else that happens with this trust issue is when we look at a policy illustration, we need to trust in the guaranteed values. And many people want to trust in the non guaranteed values, which are much higher and can be more exciting, but they're not sure.
Mhm.
And so we need to look at the guaranteed values of the policy, see, is that something that could be valuable for me, for my future, and put our trust in that rather than in the non-guarantees that may not be there.
Agents often are telling you all the possibilities instead of the probabilities. We want to focus on the guarantees, and you should too when you're looking for life insurance, the guaranteed values, because the non-guaranteed or the possibilities often never show up.
Well, there's a lot to know about life insurance, and there are a few critical things that you should know to make sure that you get a good policy. We're going to talk about how to get a good life insurance policy right after the break.
After 17 years of selling and reviewing life insurance, we've developed a checklist of all the things that we look for in a policy to determine whether the policy is a good policy or a bad policy. We are pleased to make this checklist available to you as a free download. You can access your copy of this checklist on our website at mcpheeinsurance.com or by clicking the link in the description box below.
The policy checklist combines what we have learned after selling and reviewing life insurance for over 17 years. Of course, we've owned it longer than that. And the first thing on the list is, what kind of policy is it?
I know that when I was 25 years old, one of my patients, Nathan Steinbach, told me, Tom, you need to buy whole life insurance. I said, Nathan, I'm going to buy term and invest the difference. And I've regretted that decision ever since. Now, there's nothing wrong with term insurance. Like we've talked about in other podcasts, it does provide liability coverage for a certain period of your life, but it doesn't provide permanent coverage, and it doesn't provide the living benefits that we're looking for.
So one of the things to ask as well, are the premiums comfortable and affordable? Sometimes people get a life insurance policy where the premiums are too much of a stretch and they get in over their head. Are the premiums guaranteed?
Guaranteed. Does that mean that they're going to be guaranteed to be paid with you, or does it mean that they're not ever going to go up? And the key here is you want premiums that will never go up and that they're guaranteed that they can never go up. Because with IUL policies and variable universal policies and traditional universal policies, there is no guarantee that the premiums cannot and will not go up.
We also want to see if the policy accumulates cash value, because the cash value is what it gives us the living benefits of the policy.
You definitely want a policy to accumulate cash value, and you want the death benefit to be guaranteed over a long period of time, as well as the premiums not going up. Because if the premiums don't go up, but the death benefit goes down, what have you really accomplished?
Mm-hmm. And does the policy have riders?
And
the
what
right
kind
types
of
of
riders?
riders? What types of riders? Term riders can often be on a policy to help boost the early cash value growth, but they come with a cost. Paid up additions riders can be on a policy that helps boost the cash value, and that's often a very efficient way to boost the cash value in a policy. But if you go too far, you can also run into some tax issues with a modified endowment contract.
So the paid up additions rider is critical because that's what gives us the cash value. It allows us to do the living benefits, but we have to look at how is that rider funded? Is it underfunded? Is it too overfunded? So that is a critical point.
What about
as well.
surrender value? There's a huge difference between the surrender value in a whole life policy and the surrender value in a universal policy. What you thought was yours may not be yours in an IUL policy or a variable universal policy. In a whole life policy, the surrender value usually is really, really close to what your cash value is.
One of the things we look at too is the premium to cash value ratio.
Mm-hmm.
Is the premium that we're putting in generating a good amount of cash value? So that's an important aspect to look at.
And when we're comparing a whole life insurance to a whole life insurance, we're also looking at how big of a dividend is being paid and how much additional paid up insurance is that purchasing. So a dividend can be really, really high and only buy a minimal amount of extra paid up insurance, which is going to very lowly affect your cash values. Whereas other companies, their dividends are really low comparatively, but the cash value that purchase is extremely high.
And dividends are what you receive when you have a mutual, your policy is with a mutual company. And so that's one of the questions, is your policy with a mutual company?
Are you a participating owner in that company too? Because you can buy a policy that's not participating, even if it's with a mutual company.
We have to find out what is guaranteed, what is not guaranteed. So that will trigger you to look at the illustration, to look at the guaranteed values and the non-guaranteed values. So you make sure that you find where those are, because a lot of people see the non-guaranteed values and they think, oh, that's what I get. No, you have to look and differentiate between the guaranteed and the non-guaranteed.
Here's an example right here, Michele, of that. This was a policy that came across our desk a few years back, and a 47-year-old male had purchased this policy, and they were paying $2,600 a month for this coverage. And in just about 6 years, there was going to be no guarantees in this policy.
And paying how much?
$2,600 a month. And there was going to be zero guarantees on the premium after about 10 years.
That's a sizable chunk of change.
It is. And here's the sad part. If he continued to keep this policy when he turned 76 years old, which is very feasible for someone that's 47 in good health, he won't be paying $2,600 for that policy anymore per month. It'll be $34,000 a month.
Well,
because of the increased cost of insurance in universal policies, whether it's traditional, indexed, or variable.
Nobody's going to keep that. Nobody in their right mind is going to keep that.
Well, if the
policy.
death benefit is not guaranteed after 10 years, so if he paid longer, that's assuming that the market was better and allowed that death benefit to. But who would pay that?
Well, they're hoping, and this is the promise that's sold to people, is that the interest earned in that policy is going to make up the difference. Okay, so
that has to be an IUL policy.
it is an IUL
the bad
policy.
type that we were talking about.
It is an
before the break.
IUL, yeah. And that represents that the market would have to do over 1,000% on the funds that he's paid into that policy to pay those premiums instead of him having to pay them out of pocket.
So he would have liked to have our checklist before he bought that policy. And he might have been able to avoid paying $2,600 a month for nothing. So then what are the policy fees? Of course, there's going to be lots of fees with the IUL. The only thing with the whole life is going to be the flat policy fee. Are there surrender fees? Does the policy allow for loans? That's an important question to ask because that's the way we access the funds for the living benefits.
And it's important to know how a policy loan would affect your policy growth too. That's a real important concept to understand, whether it's whole life, whether it's universal life, or there's various ways a policy loan will affect whole life because not all whole life policies are the same.
Also want to find out what are the policy deadlines. So when do you pay your premiums? And then with IUL, there's lots of deadlines. The IUL illustrations have very long portions of fine print reading. So get out your glasses and read the fine print, but they'll have a lot of deadlines in there that can change the values of the policy if they aren't met on time. Also, what commissions could be earned? What type of insurance does your own agent have? That might be a question to ask. And is the agent trustworthy? That would be certainly something of consideration.
This is a master list that you can use for a policy that you already own to find out if it's a good policy or a bad policy, whether it's going to cost you a fortune in the future or whether you need to cut your losses now and find something that's better suits your needs. The other thing this master list can be used for is to look at an illustration that you've been provided by an insurance agent and find out before you ever spend a dime whether this is something you should put your money into. There's no sense in losing money when you're buying insurance. At McPhee Insurance, we always say you should never pay more for your insurance than you have to. When someone comes to us at McPhee Insurance, we meet with them to sit down and find out what their needs are, what their desires, where their goals are financially, because not every life insurance policy fits everyone's needs. We have to find out where you are so that we can design a policy that's going to make your needs be met. Then the application process takes place. That's the easy part. It takes about 15 or 20 minutes. And now it goes through underwriting and it's issued. And then you get to start owning this policy and start managing it. And that's where the third thing that McPhee Insurance always does. We are always there to support you for as long as you own the policy.
I'm thinking of a doctor on the East Coast right now. He didn't buy his policy from us, but after he bought a policy, he couldn't reach the agent anymore. And that is not acceptable. And his case, unfortunately, is not an isolated case. When you do business with McPhee Insurance, it's different. We want to be there to support you throughout the process of you owning and using your life insurance policy, and always be there to answer your questions and provide you with the next steps.
Using this checklist, you'll be able to distinguish good life insurance from bad life insurance. This is the most cost-effective way to make sure that you have a good policy. And it's available as a free resource on our website. If you're someone who wants it done for you, we can help you do that too. You can give us a call, 702-660-7000, or email us team@mcpheeinsurance.com.
The policy checklist is free, and the link to get it is in the description. But if you want the review done for you, it's well worth the $75 we charge to give you financial peace of mind.
With interest rates rising, being in debt is getting more and more expensive every day. Next week, we talk about how to be debt-free right here on Multiple.